So far, 2023 has been a better year for investors. At the time of this recording, the S&P is back in positive territory, up 4% on the year, and Bitcoin has been soaring, up a huge 62%. Now, the big question for today is, was the bottom hit at the end of last year, or is everything going to roll over and we're headed down to new lower lows? Well, today's macro expert says a recession is coming our way, and the reason that a recession would suck for investors is because historically the stock market and risk assets nearly always crash during a recession. And so in this video, we'll be covering three main things: why a recession is likely coming our way and when, then where he thinks the ultimate bottom will be for the stock market, and then we'll finish, during a recession, which asset classes do you want to be holding? We'll be looking at the winners and the losers. As always, if you do enjoy anything in the video, then drop a like. Always appreciated. Okay, first up, we turn to some analysis done by the former head of investments at ING, where he managed a portfolio of $20 billion. And he explains why and when a recession will hit.
So I looked at the depth of the yield curve inversion to try and predict whether a more inverted yield curve, David, and an inverted yield curve for longer actually predicts a worse recession. It does, David. And it makes sense, right? Because the more the yield curve is inverted and the longer it is, basically the bond market is telling you have been choking the economy for a longer period of time. That's what it tells you, right? And it also tends to predict well when a recession will be. Now, we have choken the economy for a long period of time now. The curve has been inverted for basically a year already. And the levels of inversions we are reaching are now the sharpest in over 4 decades. If you look at the 3-month yield minus the 10-year yield, as we speak, it's more inverted than in the 80s when Volcker was trying to fight inflation. That's the levels we are at today. So if you look at these measures, it would suggest that you would lose about 2 to 3 percentage points of GDP, but most importantly, in unemployment rate. That's easier for people to, I guess, get the relationship with. Today, we're at about 3.5%, 3.6%. If my base case recession realizes, then you're going to get an unemployment rate up to 6. Again, I think the easiest is look at earnings and look at unemployment rate. And if I try to model where earnings are going and unemployment rate is going, David, you're looking at something that is maybe not the size of the 2008, 2009 recession, but not very, very far away from that kind of recession, let's say. So something not negligible.
Now, a question that comes to my mind is the yield curve a good predictor of recessions? Well, according to Investopedia, an inverted yield curve is one of the most reliable leading indicators of an impending recession. And Alfonso added to that, how inverted it is and how long it's been inverted also shows how bad the recession is going to be. And it was at a 40-year low, so pretty bad. He says it won't be quite as bad as the 2008 great financial crisis, but it is going to be significant. Okay, so we know recessions are not good for stocks and risk assets. So the next big question people want to know is, well, where is the ultimate bottom for the stock market?
I think people ask me, where does the S&P 500 bottom? That's the question everybody wants to try and get an answer for. My answer for that question is about 3,500. So it's not, I'm not going to say 3,000 or 2,500. And the reason is pretty simple. The stock market, David, does not bottom when earnings bottom. It bottoms before that because the Federal Reserve has eased already a lot. And at that point, it starts feeding into markets. Some optimism comes back through valuations. So even if earnings continue to drop for another few quarters, the stock market stops dropping at that point. I think 3,500 is a very reasonable level to expect. Guys, we're talking about almost 1,500 points from the top. It's a very serious decline, peak to trough, if that realizes.
So let's just take a quick look at the S&P 500 and see where is he predicting that it's going to. Well, this was the high, this was the low, and he's predicting it'll be going to the 3,400 level, which is around about here. So considering it already went down to 3,487, this is actually not a huge crash prediction, but more of a double bottom. And 3,400 is about here, which would take us back to the pre-COVID level. So again, not an extreme crash prediction, but it just says that it'll be coming down and, like I've talked to before, into this more healthy range, which it's been in for many, many years.
The best period, David, to buy bonds is when nobody wants them. Like when everybody says this is the worst investment you can ever have in your portfolio, I hate bonds, bonds are useless for the next decade. Generally speaking, you want to have bonds. Look, for gold, I think it's very reasonable. You have a banking crisis. It's disinflationary. It scares the Federal Reserve, right? So it also makes the dollar weaker, which generally is a very good tailwind for gold. People realize the money they have in a bank account isn't as safe as they thought it would, David, so they look for alternative elsewhere. Interest rates come down. All of this is super supportive for gold, and it makes sense, right? So you have gold rallying as a safe haven role, negative correlation with interest rates. So interest rates come down, gold goes up. It all makes sense, right? Bitcoin has been really interesting because effectively it's been acting like digital gold. It's been acting like a high beta version of gold, right? But in the past, David, we have also seen that Bitcoin acts like a risk asset sometimes, right? I mean, if risk assets are doing well, equities are doing well, then Bitcoin rises and vice versa. It's been very interesting. I am not convinced that if we go into a recession, Bitcoin is going to have that safe haven property that it seems to be having now. So I'm much more convinced about gold at this point in the cycle than I'm convinced about Bitcoin being a good investment. If you would ask me which one to choose to be a diversifier or defender in the portfolio, I'd rather have gold at this point in the cycle.
Former head of investments at ING, Alfonso Pecacello, says investors should not be getting too excited with this latest run in assets as a recession is still on the way. One of the best leading indicators for a recession is the yield curve, and it's been inverted for more than a year and to an extreme not seen for over 40 years. He sees the bottom for the S&P 500 to be around 3,400, which actually would be more of a double bottom, so not too extreme. And he sees Bitcoin going back down below $20,000. And he says the best place to be to weather the storm would be bonds and gold. And he sees crypto heading back down with stocks. So there you are, guys. Hope you enjoyed. Now, as you can see, the battle for the bulls and the bears rages on, which is why I always prefer to have a plan for both directions. But let me know your thoughts below. And for now, just to say, if you did enjoy anything in the video, then drop a like. And a big thank you to everyone who does. And I'll see you in the next video. Bye for now.